Agam Gupta, MD of FI Trading at Standard Chartered Bank, joins us right now on the show. Agam, good as always having you. Thanks for joining in Neeraj here afternoon. Do you just the moot point being, do you expect these measures which have been taken by the RBI, not just yesterday but over the course of the last maybe 2 or 3 weeks, to stay on for the next 2 or 3 months to drive home the point, or could they actually last even longer than that?
No, I think the big measures are the ones they announced yesterday and the ones they announced last Monday, the liquidity tightening measures. These are definitely short-term measures, and I don't think they're going to last more than 2 months.
Yeah, so Agam, afternoon, just wanted to know that given that you believe that they are short-term, is it perhaps at the back of the RBI's mind that, there is clearly more downside to the rupee, it's just drawing up each and every tool that it has with it, because the last time around also, when it did come out with these measures, the gains were very short-lived.
Yeah, so I think these short-term measures are to curb the volatility and to prevent further depreciation and to stabilize the currency. I think the base case right now that I'm looking at is stabilization around 59, plus minus 50 paisa. So if these measures are short-lived, then what next? We expect some sort of announcements in the coming months, which could be on the line of an NRI bond or sovereign bond. There's a good chance of that happening, and that's when they could remove these measures.
In fact, so those are going to be my next 2 questions. Let's tackle each of these issues. One, do you believe that by virtue of the fact that the yields have gone up to where they are, there could be some FI activity in the bond markets because of how the bond prices have fallen? And 2, does that kind of an impact get negated by potential outflows from the equity markets because they are fairly wobbly by virtue of what the RBI has done and the fear or the overhang of such moves?
Yeah, I think it's a little too early to talk about inflows from the debt FI sector right now. They already are sitting on some positions and they are bleeding on them. Having said that, I think if yields stabilize at a higher level, the currency stabilizes around 59, then you will see some fresh buying coming in from real money funds. So it probably will start once there is some stability in markets, and maybe once the monetary policy from the RBI next week is out of the way. The FI outflows, as you said, could counter these debt inflows. So net, it could be a kind of a flat kind of a reaction on the flow side. I don't expect the debt FI flows to come in before stability returns to the market, and these also are not going to be big enough to really impact the currency on an appreciating bias, but it could help towards further stability.
Agam, our research analyst just flagged off that the bond yields, the 10-year bond yields are at levels of close to 8.3, thereabouts, the highest since June 2012. What kind of an impact would these measures have had on the bond markets, and what's the trajectory that you're now penciling in?
Yeah, obviously, before the measures were announced last week, the 10-year was trading close to 755, 760. So from there we have moved a good 75 basis points. Going forward, I think because most of the players in the market, and I think rightly so, are assuming that these measures are short-lived, and also once stability returns to the market, these measures will be removed. I don't really expect any sort of repo rate hike coming from the RBI in this policy or in the near term. So, once market stabilizes, I think around 8.5 to 860 on the 10-year is a good level to buy bonds.
Okay, but you mentioned that maybe some flows come in or go out after the RBI's policy meet. Do you think that remains a mere formality and more focus would be on the language, or do you believe there could be some action too after all that's happened the last couple of weeks?
I think they're not going to do much in the policy. If you're looking at from a rate perspective, they've already done what they had to do, and I think the measures that they announced yesterday are going to ensure that overnight money and short-term money market rates are going to be reasonably tight till these measures are in place. So they don't have to do anything more in the RBI policy on the tightening side. That's pretty clear.
Okay.
But also going forward, if you could just run us through, there were expectations maybe that in order to given the fact that the currency is going to be the topmost priority for the RBI, maybe not in the next policy, but that it is possible that we might see some rate hikes in the latter part of the year as well?
I don't think so. I mean, I don't think RBI is going to hike rates on a permanent basis to protect the currency, because it might just be counterproductive. It's not as if higher rates are going to, I think higher rates are going to lead to a further slowdown in the economy, and it's not going to be really conducive for inflows. What we need is either, reduction in the import bill, or we need some capital inflows. These are the two things we need. So these are short-term measures. They're put in place. I think there could be further measures which are going to be on the inflow side, which could be in the form of a sovereign bond, NRI bond, or they could do some measures which are going to reduce the import bill. They could be, hiking duty, import duty on some high-end consumer goods. These are the measures they need to put in. Higher rates on a permanent basis, I don't think they're going to really go that way to kind of protect the currency or to strengthen the currency.
You mentioned the NRI bond bit. One, how soon do you think that could come about? And two, what's the kind of return they need to show on that for it to maybe make a bite with investors?
On the time frame side, if they have to announce something, it will come within this next 1 to 2 month window when these short-term measures are in place, because that's when the real inflows can take over and the short-term measures can be removed. It obviously has to be attractive enough for the NRIs to bite. I'm not too sure about what level it would be at, but yeah, it has to be higher than what market levels will be.
One final question. Call rates above 10%. If indeed the borrowings are done to the LAF window, it's probably not too far off the raise in the deposit rates. Do you think that happens as well?
Yeah, I think short-term deposit rates will definitely get hiked, because if you're looking at call rates at maybe 10 quarter, 10 half, 10.75 also maybe for the next 2 months, that automatically will lead to money market rates and deposit rates in the 3 month, 6 month buckets definitely getting raised, getting hiked.
Okay, it's been great chatting with you, Agam. Thanks so much for taking the time out and joining in with that perspective. That's Agam Gupta, Standard Chartered.